Okay, firstly, the thing that gives you the best guide is something called the ISM survey. And you can Google it, you can find it, it's publicly available. And that basically, anything above 50, the economy's expanding. Anything below 50, it's kind of stalling. And anything below 47 is a recession. And that's been going since about 1947. It's an incredibly good indicator and really useful. So think of it as a kind of weekly version of GDP. So that gives you a very quick ballpark. And what's really interesting that no economists figure out, and I don't understand this, is it goes up and down. It's cyclical, right? Economists have linear projections. It's like, really? You can show a small child a chart of GDP and they go, well, it goes up and down. So what it does, if you see it going down and crossing 50, you know we're likely to be headed into a weak patch or a recession. If it's coming up from the lows, we can start looking forwards. So that's a really simple guide. The other way is the bond market's usually very good at this. So once yields start falling, bond markets are generally derive their price action from two things: GDP growth and future inflation. So if bond yields are rallying, it's saying that GDP is probably slowing down, i.e. there's a chance of stimulus to come and bonds look a safe haven. And secondly, that inflation is likely to come down in the future. So those two things alone give you pretty much all you ever need to know. Now, what's really interesting, the second degree of all of that is there's a bit of magic. So you look at this ISM survey, you go, well, how does it help me with my equity allocation or my allocation? All you do is just turn it into a year-on-year chart. And all of the year-on-year charts of every asset, from oil to bonds to commodities, to copper, to equities, to emerging markets, to credit spreads, are all the same charts. They're driven by the business cycle. And some things are pricing in more right now and others are pricing in less. So the bond market's pricing in less, as is the oil market. But things like tech stocks are pricing in an ISM of 35, which is a deep recession. So then it gives you kind of a relative understanding of, okay, where should I be looking at allocating my money? So there's some relatively simple tools.
So now I listened to you and I saw your really interesting conversation. I think you pronounced the name Urian from Fidelity, and you all have a phenomenally compact, elegant way of explaining this. And so, but with so many people now starting to understand this, is this a self-fulfilling prophecy? Meaning, what comes first here, right? When I see that the NASDAQ price in your chart is saying, the ISM is going to fall to match that because it has for the last 50 years. Is that now a self-fulfilling prophecy, or do the markets not think that way? Meaning, what comes first here, right? Is it a chicken and egg thing? And does that change over time if everybody understands the same thing?
Yeah, I mean, does technical analysis lead to price action or does it not? All I know is if you listen to Stan Druckenmiller over the last 20 years, every time he gives an interview, he says, you know where the economy is by looking at the internals of the stock market. What does he mean? It means things like consumer discretionary stocks versus utilities. If the economy is slowing, then discretionary stocks, i.e. the discretionary spending, tends to fall. Utilities are the things we have to have, so they tend to do well. They're all correlated with the business cycle. The business cycle, I mean, I've got business cycle indicators going back to 1870. They still work. So even though more people might look at them over time, I still don't think it's necessarily the driver of price action. If not, you would have seen more assets priced in the same move, but we haven't, right? We've got bonds up here, haven't priced in much of a weakening ISM. And then we've got tech stocks, which are at the bottom, which are priced in a massive amount of weakening. So it's clearly not efficient yet.
Yeah, and we still see contrarians, right? So it seems to me that there's a lack of consensus on, is the Fed really going to have to pivot versus is that kind of long-term trend line downward on interest rates no longer, a viable predictor of where this is going? And so, what should be, over decades, kind of a reasonable road to consensus actually doesn't really feel that way, the way one might expect. Is that true? Or
so always at turning points, there is no consensus because there's a group that extrapolates the recent trend and says that's going to continue. And there's a group that extrapolates a mean reversion. Now, the question is here is more complicated because we've got these supply issues, we've got, onshoring, we've got other things that are muddying the equation. And what we've got is this big debate. So myself, David Rosenberg, and maybe Urian and a few others kind of think we probably mean revert because of debt, demographics, technology, that inflation's not a long-term issue. But there's a whole other group who I really respect who are saying, no, you're dead wrong. Inflation's sticky, it's here to stay, and it's a big problem. And we won't know, and this is the beauty of financial markets, right? It's game on now. We've got the game, we place our bets, and we'll find out who's right and who's wrong.
Sure. But it does feel like in some ways, I realize that the talking heads are always going to be, many of them are going to be a trailing indicator, but it does feel like many prices have either peaked or are starting to come down. And that's really what matters here, more than the actual inflation level itself, in terms of, we're going to get into crypto and equities and whatnot, but isn't that a more important perspective? Yeah,
all prices are set at the margin, and marginally all prices are falling, except, even oil's fallen, but not as much as others. But stuff like copper, that's very economically sensitive, been decimated. And we've seen that in agricultural commodities, we've seen it in all commodities. Now, Elon Musk tweeted out yesterday, somebody who'd been talking about the inflation in his supply chains, said, we're seeing prices peak.
Yeah.
Okay. Yeah. He is a consumer of a lot of different raw materials.
That's right.
And he's telling us this. And we're seeing that all over the place. So why is it at 9% now? Well, inflation is a lagging indicator. It looks back over prices. So still we're seeing some companies pushing through price increases of commodities that they bought 6 months ago, that they've turned into cereal boxes that they've now put on the shelves, right? So it's a delayed process. And eventually the delay comes the other way. The other big delay is rents, because the housing market is slow to move. It's not like equity markets that can move very quickly. So as the housing market comes down and mortgage rates come down, rents will slowly come down. But that can take a while. And it's the same with wages. So we're now just starting to see all the tech companies laying off people, all the crypto companies laying off people. So that's going to be pretty broad-based and pervasive. It's not gigantic because oil companies are doing well and other people are doing well. But that process then feeds through. So usually what happens is 18 months later, 12 to 18 months later, you get the reverse. And I actually think we go to negative inflation, which is not what anybody else thinks.
Right. I was going to ask you about that. I mean, I've been listening to Kathy Woods, and I'm a huge fan of hers, and I think it's really interesting to see your intersection of macro, and you talk about exponential. And I'm a technologist at heart. I'm a closet guy who's worked in fixed income, but I don't have your depth of understanding. But the three of us have kind of converged from very different perspectives. I'm a pure techie who's made his career in working in exponential tech, and you come at it from macro, and she just runs funds that only focus on it. And that prevailing wisdom says, well, wait a minute, even with the money printing, it looks like there's a really good chance that we're going to end up in a deflationary environment at some point in the next 24 months.